So I was browsing the internet, doing some research, and I came across this article that spoke on the recent Fed meeting, and it is predicting that we'll be reaching the end of the interest rate hikes as early as this summer. So let's take a look at this article from Reuters, and then we'll break it down, and I'll give my opinion. So the headline reads, Fed raises rates, opens the door to a pause in a tightening cycle. The U.S. Central Bank raised its benchmark overnight interest rate by 0.25 percentage point to the 5% to 5.25% range as expected by financial markets. But in doing so, dropped from its policy statement language saying that it anticipates further interest rates will be needed. But closer, or maybe even there, Powell said, of the end point of rate increases that have boosted the Fed's policy rate by a full 5 percentage points in the 10 meetings since March 2022. A torrid pace for the central bank, and one that may now warrant allowing some time for the impact to be felt in full. And then the article goes on from there. So here's my thoughts on this. First off, I don't believe that we've seen the last of the interest rate increases. Even though we're heading in the right direction, the last thing the Fed should do is actually take the foot off the gas. Heading into this meeting, the big topic of speculation was in which direction the Fed would take, especially when you consider the shakeup in the banking sector. Now, with the notable collapse of Silverstone Bank, Silicon Valley Bank, Credit Suisse, and latest the FRC, our First Republic, the so-called experts and analyst predictions vary from the Fed performing a minor increase to some calling for an actual reduction. But as we all know by now, the Fed settled on a modest 0.25 basis point increase. And now we can start to look ahead and make some educated estimates on where we think things will head from here. Now, one thing that contributed to the high inflation was the amount of excess cash available to banks, which was made available to support the level of interest rates in the economy. So back in 2020, there was a substantial amount of liquidity available, and as part of the tightening exercise that was initiated by the Fed in 2022, the excess Federal Reserve balances have been gradually reducing since then. Now, and this is one of the tools in addition to interest rate increases that the Fed has been using to fight inflation. But given the recent turmoil in the banking sector, the Fed had needed to step in to provide the liquidity needed for insured depositors to access their withdrawals. Now, if you access data made available from the Federal Reserve, the amount of money that was actually made available to these institutions increased substantially, going up by over $350 billion over that span. But here's a problem with that. If you provide such liquidity, even though it helps stabilize the banking industry, it actually also brings back some of the problems with cash overflow that came with inflation. And that's something that I believe the Fed does not want. So I believe we can actually see a scenario where the Fed stays focused on ensuring that the excess Federal Reserve balances remain on that negative trajectory and the need to correct this slight uptick that occurred recently. Again, the battle against inflation continues to be a challenge. And even as they put the pressure on, at the same time, they're trying to avoid an economic crisis. Now, there's been some progress. If we look at the CPI data, this indicates a steady drop in inflation with the expectation of March, where we saw a 5.6% increase, but it's definitely an improvement from the 6.6% inflation of 2022. Now, the main challenge is everyone is waiting for the bottom in order to take advantage of investing, and investors are looking for any sign to start pouring their money back into the market. That's why I keep hearing things like buy the dip, or people saying that the bottom is in. And by the way, if anyone tells you that the bottom is in, definitely do not believe them because they don't have a crystal ball. So we've been seeing mini rallies that make people think that the market rally has started, but so far that has not been the case, and it has only prolonged the market from reaching its true correction point organically. So the Fed doesn't want its legacy to be one in which it lost the fight against inflation, which is why their mandate, in my opinion, can be simplified in two terms. 1. Get inflation down to 2%, and 2. Don't break the economy while doing number 1. So what does this mean for the everyday investor or for someone that's looking to take advantage of current times? Well, we know that this recessionary period brings a lot of volatility, and depending on your risk tolerance and the amount that you're looking to invest, there are several opportunities that present themselves outside of traditional stocks. Now, from what we see so far, those with a smaller budget or a low risk tolerance have moved towards certificate of deposits, as those are offering a higher yield than traditional savings accounts. Now, it's not difficult to find CDs that offer returns between 4 to 5%, and if you're someone that can't afford to lose any funds but still want to see some growth in your money, a CD is a decent option. The caveat here is that there can be a penalty for an early withdrawal of the money, so you need to be confident that you will not need the money before the maturity date. Now, if you go one step beyond CDs, bonds and income vehicles have become more attractive. We've seen a rise in the number of covered call income ETFs, as those are proven to be a steady source of income in these volatile times. Now, these are lower growth equities, but they do offer protection against the downside of the market, So it looks like a lot of investors are preferring that option as a way to safely grow and preserve their money. Now, another opportunity that does present itself is in the real estate market. Now, if you have quite a bit of money, with the rise of interest rates, there have been a drop in competition at certain price points, which has resulted in a cooling down of housing prices. Now, if you're a real estate investor or looking to get into real estate, this might be a period to reevaluate the numbers against what's out there to see if the right deal is available. Now, depending on when you're watching this video, prices in the market might vary, obviously, but it is something to consider. Now, if you have an even bigger budget to invest, buying a small business could be a viable option. Now, with these higher interest rates, banks are getting stricter with their lending in order to maintain liquidity. Now, this could have an impact on small businesses that are struggling financially to keep up with payments and owners that are looking to sell. Of course, this is risky, and if you're buying a business, you need to know whether the business is actually struggling due to management or if it's just a failing business model. So once again, the Fed has an obligation to fight inflation, and they'll do just what they've always done, which is to analyze the data, and as long as the economy continues to respond positively, then they will keep raising rates. Now, this is just my opinion, but Jerome Powell did hint at something like this in his words at the March Senate Banking Committee meeting. Now, he said, although inflation has been moderating in recent months, the process of getting inflation down to 2% has a long way to go and is likely to be bumpy. It's going to take some time to get there, so the best we can do on our side is to be prudent with our money while looking for safe investment opportunities.